the 1st of March, 2026. A tanker called the MKD Viom is struck by a drone in the Strait of Hormuz. The ship takes damage. The crew is in danger. And somewhere in an office in London, a phone starts ringing. The question on the other end of that phone is a very simple one. Which insurance policy pays for this? The answer is not as obvious as you might think, because a ship at sea carries at least 2 separate insurance policies. And when a drone hits a vessel in a conflict zone, the policies do not automatically overlap. One of them might pay, the other might not. In this episode, we are going to understand the difference between hull and machinery insurance and war risk insurance, and exactly how the claims process works when a vessel is damaged in a conflict. Let us start with the first policy, hull and machinery insurance. Often abbreviated as H&M, hull and machinery insurance covers the physical structure of the ship, the hull itself, the engine, the mechanical systems, the navigation equipment. It is essentially the insurance policy for the vessel as an asset. Think of it like comprehensive insurance on a car. If the car is in an accident, your policy pays for the repairs. Hull and machinery insurance works the same way. If the ship is in a collision, runs aground, or is damaged by a storm, the H&M insurer pays for the repair cost, up to the insured value of the vessel. The key word here is accidental. Hull and machinery insurance covers accidental loss and damage. It does not, by default, cover war. The war exclusion is written into every standard H&M policy. It is not a gray area. It is an explicit clause. So if a drone strikes your tanker and it is clearly a hostile military act, your hull and machinery insurer will review the claim very carefully. And in many cases, they will decline it. This is where the second policy comes in, war risk hull insurance. War risk hull insurance fills exactly the gap that the H&M policy leaves open. It covers physical loss or damage to the vessel resulting from hostile acts, missiles, shells, mines, torpedo attacks, drone strikes, sabotage. It also covers something that surprises many people, capture and seizure. If a government or military force detains your vessel, even with no physical damage at all, your war risk hull policy can pay out the full value of the ship. This is what happened to vessels detained by Iranian forces in previous years. No damage, but the ship was gone. That is a war risk hull claim. There is also a lesser-known clause called blocking and trapping. If your vessel becomes physically stuck inside a port or canal because a conflict has closed the waterway, and the vessel cannot move for a continuous period, typically 6 to 12 months, your war risk hull insurer pays out the vessel's full insured value. Think about the vessels trapped in the Persian Gulf right now. If the blockage persists for 12 months, those blocking and trapping claims could be worth hundreds of millions of dollars. H&M insurance and war risk hull insurance are not just different in what they cover, they are also structured and priced completely differently. H&M is an annual policy. You pay one premium at the start of the year. That covers your vessel for 12 months against accidental damage, wherever it trades. The premium is based on the vessel's insured value, its age, its flag, and its trading history. For a standard VLCC, an annual H&M premium might run to several $100,000. War risk hull, before the Hormuz crisis, also worked on an annual baseline policy. But here is the crucial difference. When a vessel enters a designated high-risk area, like the Persian Gulf, the annual policy is effectively suspended, and the shipowner must pay what is called an additional premium, or AP, for that specific voyage or call. Before the crisis, APs for the Persian Gulf clustered around 0.15 to 0.25% of the vessel's hull value per voyage. For a $120 million VLCC, that is roughly $180,000 to $300,000 per sailing. After the 28th of February, those APs spiked to 1%, then 2.5%, and for US or UK flagged vessels, some underwriters were quoting 5% or higher. On a $120 million vessel, 5% is $6 million. For a single voyage, that is not an additional cost. That is the voyage cancellation number. Let us walk through exactly what happens when a vessel is struck in a conflict zone, step by step. Step 1. The vessel is damaged. The master files a notice of protest, a formal document recorded at the next port stating that the damage occurred under duress. The insurer's surveyor is appointed immediately to inspect the vessel and assess the damage. Step 2. The cause of damage is investigated. This is critical because the cause determines which policy responds. If the damage is ruled as accidental, H&M pays. If the damage is ruled as resulting from a hostile military act, war risk hull pays. The burden is on the insurer to prove it is a war cause if they want to deny the H&M claim. Step 3. If it is a war cause, the claim goes to the war risk underwriters. They assess the damage against the vessel's insured value. If repair costs are less than, roughly, 75% of the insured value, a partial loss is paid. If repair costs exceed the insured value, the vessel may be declared a constructive total loss. The shipowner receives the full insured value and hands the wreck to the insurer. Step 4. P&I liability claims for crew injury, pollution, or third-party damage are handled separately by the P&I Club under their war extension if it was in force at the time of the incident. Here is where it gets complicated, and where disputes between insurers and shipowners can last for years. Not every hostile act is clearly a war act, and the line between war, piracy, and terrorism in insurance law is not always obvious. For example, a Houthi drone strike on a tanker in the Red Sea. Is that war? The Houthis are not a recognized state. There is no formal declaration of war. So, is the strike covered under war risk hull, which covers acts of war? Or is it covered under a piracy clause in the standard H&M policy? Or is it neither, and the claim falls into a gap? The answer depends entirely on the specific policy wording. Some war risk policies use the phrase hostile act by or against a belligerent power. A non-state actor like the Houthis may or may not qualify as a belligerent power, depending on the jurisdiction. This is not a theoretical point. After the Black Sea conflict, after years of Houthi attacks in the Red Sea, insurers and shipowners have been in litigation over exactly these questions. The lesson for anyone working in shipping or trade finance is this: always check the precise wording of the war exclusion and the war risk coverage clauses. The gap between them can be worth tens of millions of dollars. Let us look at what the 2026 Hormuz crisis actually did to the combined cost of insuring a vessel in the Gulf. Before the strikes on Iran, marine hull insurance rates in the Gulf were already under competitive pressure. There was excess underwriting capacity in the market, and rates had been softening. War risk additional premiums for the Persian Gulf clustered around 0.15 to 0.25% of hull value. Within 48 hours of the 28th of February, everything changed. Brokers at Marsh estimated near-term marine hull rate increases of 25 to 50%. War risk additional premiums jumped from that 0.25% baseline to over 1%, virtually overnight. By the 11th of March, high-risk propositions, specifically US, UK, and Israeli Nexus tankers, were being quoted at 7.5% in some cases. Reports from later in the week suggested 10% or more was being asked for those vessels. Lloyd's underwriters began referring to US Nexus tankers as, and I quote directly, missile magnets. In total, marine war premiums for Hormuz transits increased to 20 times their usual rate within days. 20 times. That is not a market adjustment. That is a market saying, we do not want this risk at any normal price. So let us bring this together. Hull and machinery insurance covers the physical ship against accidental damage. It explicitly excludes war. War risk hull insurance fills that gap. It covers damage from hostile acts, missiles, mines, drone strikes, capture, and blocking. It is priced as an additional premium per voyage into a high-risk area. And in a crisis, that premium can multiply 20 times in 48 hours. When a vessel is struck, the cause, not the location, determines which policy responds. And in the gray zone between war, terrorism, and piracy, disputes can last years. If this series is helping you understand the business behind global shipping, please subscribe to Trade and Shipping Explained on YouTube. Follow us at @TNS Explained for every new episode as it drops. In episode 4, we are covering the ship at the center of all of this. The VLCC, the Very Large Crude Carrier. What it is, how big it actually is, what it costs, how it is insured, and why losing just one of these vessels in the Strait of Hormuz would trigger claims that could reach hundreds of millions of dollars. That is episode 4, coming in next few days, only on Trade and Shipping Explained.